The government of Kenya is now targeting SACCOs, or the deposits and the money is held by SACCOs. That is money belonging to the members, to use them for as loans, so for the SACCOs to loan to the government. But let's just take it back and remind ourselves of the origins of the SACCOs. The history of the SACCOs is very interesting because SACCOs have been around for more than 180 years. And of course, SACCOs is what is known as the Savings and Credit Cooperative Organizations. And they were born out of poverty, economic inequality, and the need for ordinary people to access affordable financial services when the banks served and still serve, to a large extent, the wealthy. Now, the year is 1844, and in a town called Rochdale in England, 28 working class textile workers came together and formed the Rochdale Society of Equitable Pioneers, and this was born primarily because of what they faced. Number one, high food prices. Number two, poor quality goods. Number three, low wages. Number four, exploitation by merchants. They pooled small weekly contributions and opened a cooperative shop that sold quality food at fair prices. See what that brought them together? The need to have affordable food and good quality. So this established what was then known as the Rochdale Principles, which, if you look today to the principles that the SACCOs follow, is almost the same thing, where the cooperatives worldwide follow. They underpin the cooperatives worldwide today. Number one, formed by voluntary membership. Number two, supposed to have democratic control. One member, one vote. Makes you remind of what is happening in Kenya in terms of the debate about the one vote, one citizen, one vote debate. And then the members' economic participation. Then education and training, cooperation among the cooperatives, and the concern for communities. So up to today, these things still underpin cooperative movements. So in between 1850 and the 1860s, that is 1860s and thereabout, this idea of people saving together and lending to one another proceeded on to the neighboring country, from England to Germany. And there were two pioneers there. I'll probably butcher their names, but because they are German and I don't know German language. One of them was called Hermann, that is common, Hermann Schussdale Delitz or something like that, who developed the urban credit cooperatives for artisans, traders, and small business owners. And then there was a guy called Friedrich Wilhelm Raiffeisen. If I butcher those names, please forgive me. I don't know Germany. I've never tried to learn Germany. Well, I did try until it proved too hard for me. I'll stick to my English and Kikuyu and Swahili and Luo and Kalenjin, whichever the language that I can speak. So this guy called Friedrich, he created a rural credit cooperative to help poor farmers who are trapped by money lenders charging extremely high interest rates. His model emphasized the community trust, membership ownership, member ownership, affordable loans, and savings before borrowing. That was his idea. Sounds familiar? And this became the blueprint for SACCOs today. Of course, as time went by and we got to 1900s, then the global expansion of the SACCOs happened. Between the first half of the 19th, the 18th, is it the 20th century? Between 1900 and 1950, the cooperative model moved rapidly across Europe and beyond, to countries including countries like France, Italy, Canada, United States, Australia, and many more. And this was adopted as their own, this concept was adopted as their own, into their own financial systems. And then, of course, you remember what happened during the Great Depression. And because of the Great Depression, many governments recognized that cooperatives could improve financial inclusion and strengthen local economies. And as time went by, of course, this was naturally going to flow onto Africa. And during the colonial era, cooperative societies were introduced into several African countries, including Kenya, and of course, other African countries, Ghana and South Africa, and many more. But they mainly focused on coffee, tea, dairy farming, cotton, and pyrethrum. Sounds like Kenya was the focal point for all this, because all these things still form the basis for the savings and credit in this country. And of course, over time, many of these cooperatives have evolved to include financial services to their members. Now, during this period, a major milestone was achieved in Kenya regarding SACCOs, and that was the enactment of the Cooperative Societies Ordinance, which formally recognized cooperative societies. And initially, membership was largely restricted to, of course, the European settlers. These guys, they loved themselves. But African participation expanded after the 1950s, of course, as we were approaching independence. So after independence, in 1963, the government strongly promoted cooperatives as a tool for, number one, rural development, agricultural marketing, savings mobilization, and poverty reduction. It was a good thing, and it has always been a good thing. So after this, in 1960s and thereabout, following that, teachers, civil servants, police officers, farmers, and employees of state corporations started coming together to form SACCOs. And of course, this was really formalized to such an extent that members contributed their savings through payroll deductions, like what you do today. Then these savings were then lent back to members at affordable and interest rates, like it happens today. And this model has been successful since then. And some of the reasons which you could think about why this has been successful since the 1800s is because members know each other. And even if they don't know each other, if, for example, they're not farmers, they're teachers from all over the country, they have something in common. Their profession, probably, their environment, or anything else. So whatever brings people together, like churches and all that. So members know each other. Repayments are deducted directly from salaries, making it very successful. The defaults have remained very low because of how this credit is advanced, and profits have been returned consistently to the members. So between 1970 and around the year 2000, there has been a rapid growth of SACCOs. And employers themselves started establishing staff SACCOs as incentives. Churches created faith-based SACCOs. Farmers' cooperatives introduced savings and credit services. Now it was no longer about SACCOs to sell their produce and to take their produce, bring coffee together and all that. And then there came in something that was very important and very interesting: establishment of transport, housing, and community groups, SACCOs. So now, if you look at the model in Kenya, for example, the public transport has a lot of SACCOs. This was brought about by this rapid growth. So by early 2000s, 21st century, Kenya had become one of Africa's leading cooperative economies. And of course, regulation and modernization had to be the thing that is happening right now with the development of this. And SASRA came into being in 2009. That is the SACCO Societies Regulatory Authority, which regulates the deposit-taking SACCOs through standards covering capital adequacy, like banks, liquidity, governance, risk management, and consumer protection. So this has shifted the SACCO movement from largely being self-regulated to a prudentially supervised financial sector. So now there is some standards that the SACCOs have to be run by. There is some rules and regulations that the SACCOs have to follow. And in Kenya today, we can comfortably say that there are over 7 million SACCO members. Actually, arguably, we can say there are about 15 million SACCO members in the country, with assets which are exceeding 1.4 trillion Kenya shillings, which is about between 8 to 9 billion USD, depending on the exchange rate, of course. And Kenya became also the country with the highest cooperative penetration rates in Africa at 33%. Of course, this has also become a very significant contribution to national savings and credit access. So SACCOs nowadays finance education, housing, farming, small businesses, vehicles, land purchases. You're always buying using SACCOs. And emergency needs. For many households, they provide financial services that might otherwise have been inaccessible or more expensive through commercial banks. So SACCOs have become an integral part of the Kenyan society and Africa in general. I'm going to be highlighting the rankings of countries around the world and according to the SACCOs, to the World SACCO body. There's a big word SACCO body which I'll be mentioning down here, and how they are ranked in the world. So we can say this year, 2026, as we speak, as I talk to you right today, that the government of Kenya is pursuing reforms in the SACCO sector. Of course, there is something very interesting about this reforms that the government ought to bring, and one of them is the central liquidity facility, which will make sure that a lot of the deposits that are held by SACCOs they have a good backing, so you will not lose your money in case a SACCO goes down. Which also means that there will be some kind of deposit guarantee, and hence they're coming up with they're pursuing us to have the country to have a deposit guarantee fund and enhanced prudential oversight. But they're coming up with something also very interesting, which is to to target the deposits by members and have the SACCOs borrow the government or lend to the government through the infrastructure fund that has been established, and make sure that the money that is sitting in the SACCOs, the government can borrow. But what I mean is the government wants to use that money to grow the infrastructural fund that they have been thinking about. So what's the government proposing? So the government is proposing that SACCOs be allowed to invest part of their funds in a National Infrastructure Fund, NIF, which is expected to finance infrastructure projects such as roads, dams, energy, housing, and rail, like how the pension funds and insurance companies and banks invest in government securities today. In practical terms, what we mean is that the government would issue an approved infrastructure investment instruments like bonds, infrastructural bonds, and SACCOs could choose to invest surplus funds in these instruments, and then the government would use these funds or those funds for development projects and repay them according to the investment terms. Now, let's dig just a little bit deeper on what this means and why it's a bit controversial. It's not a bad idea, but it's a bit controversial, especially to my judgment. So why is this controversial? Number one, Kenyan SACCO sector holds more than 1 trillion Kenya shillings in deposits, in member deposits. And of course, the government is under pressure to finance infrastructure while containing public debt cost. And many people are concerned that these savings could become a significant source of the funding. Is that a bad thing? Probably not, but the effects of such would be interesting to look at. Number one, infrastructure projects can take years to generate returns. And if the government finances deteriorate, SACCO members, should the government, because it doesn't have to happen, but should the government finances deteriorate, SACCO members would be indirectly exposed because their money is held in NIF and probably already used to develop infrastructures. So they don't have direct access to that money. And intrinsically, members were not necessarily saving for their money to finance government projects. So that is a bit controversial. Of course, the government will say that the participation will be structured and voluntary and not compulsory. We are yet to find out that because the wording of whatever is being proposed will mean a lot, whether it is true or not. And investments would be made through regulated financial instruments and broader platforms. Thank you very much. And then the government would also argue that there will be broader reforms, including a deposit guarantee fund and stronger regulations. Not so bad. So my question is, could the government make it compulsory? So as of today, there is no enacted law requiring every SACCO to lend money to the government or invest in the National Infrastructure Fund. So the current discussion, of course, is centered on creating legal framework that would allow such investments under regulated conditions. However, whether this participation is entirely voluntary is a bit of concern. And then the other question would be, will the investment limits apply? Will there be limits apply? We are yet to know that. And who will make the investment decisions? Would it be the SACCO board or the members? Don't know yet. And what protections exist if projects underperform? Very critical questions for us to ask ourselves. So number one, I repeat, number one, will participation remain genuinely voluntary? Will there be prudent limits on how much SACCOs can invest? Will members have transparency about these investments? And will the returns adequately compensate for the risks? So imagine you've been saving in your SACCO for a long period of time. And under this new arrangement, SACCOs invest in bonds, government bonds, which are 13 years, 14 years, 20 years. So it will take that long for these monies to come back. Will the SACCOs have adequate liquidity for them to provide the members' savings in case a member wants to withdraw from the SACCO? Will there be enough money if already the money is invested in long-term bonds? So good questions to ask of course, the people who are perpetrating this. And of course, this means that the SACCO management will have to think really hard on whether this is what they want to do. So of course, then there is the risk of concentration risk. That's bad English. There is the concentration risk because if governments allow SACCOs to invest, say, 40%, 50%, or 60% of members' deposit, that means there will be a high concentration risk of the investments that the SACCOs do. So if the government, for example, God forbid, experience repayment difficulties, SACCO members will be affected. So diversification is very important. So a risk that the SACCOs have to look and think about. Number two is the liquidity. Well, this is number two. Or number three, liquidity. We talked about the membership funds there. Liquidity. I think it couples up with my first statement up there that says members expect to withdraw deposits or expect to have emergency loans. They expect to have school fees loans, development loans. And if the government infrastructure investments usually take so long, because they are usually long term, will there be too much money tied up in those infrastructure projects that now members will not be able to, will have it hard, or it will become a difficult thing for you to get a loan from the SACCO? Because, of course, government infrastructure bonds and NIF is likely to have very good returns vis-a-vis the loans. So you as an individual, you think about it this way. Banks, when they lend to commercial banks, when they lend to the government, what happens is that they reduce the lending to individuals because government lending is secure. So then the risk for individual lending is very high. So they would rather lend to the government than lend to individuals or small businesses. And this is exactly what is likely to happen in this scenario as well. So people, the SACCOs, are likely to lend to the government and ignore the common mwananchi, probably structurally. Some will figure a way to make sure that there will be frustrations, takes a longer period of time before you get a SACCO loan and all that, other rules. So something to ponder about. And then, of course, the other concern will be the governance. Of course, we talked about this a little bit earlier. So who will decide on what to be lent to the government? Is it the board? Is it the annual general meetings for SACCOs? Is it the CEO? Is it SASRA? Because members want assurance that investment decisions are made prudently and transparent. So, question marks. And of course, there is the political risk. Infrastructure projects remaining, sometimes face delays, cost overruns, corruption, changes in administration. If the opposition becomes the government in the next election, what happens? Will the policy continue or what? So those are some of the things that you really have to think about this proposal by the Kenyan government. Well, if managed properly, it could have very good returns for the SACCOs because the government infrastructure bonds pay higher than ordinary deposits, which could improve SACCO investment income. And of course, support the national development, job creation, economic growth, improved transport and all that. We cannot argue against that. That is true. So when you think about it, it's just something that is interesting and really good, but also with a bit of concerns, especially when it comes to the reasons as to why SACCOs were formed, is to help the members when they're in emergencies or to help them when they have a common problem. So when the player like government comes in as a major borrower, then this, I think, I'm just saying myself, this may become the fundamentals of the SACCO may be shaken just a little bit, because now the money of the profitability, the profitability factor becomes more prevalent than the issue of members' welfare. What do you think? What's your take on this? I'd love to hear your thoughts on the proposal that the government is giving. SACCOs investing in national infrastructure funds and government bonds, basically. What's your take? Adios. Let's meet in the comment section.